about stocks this week. The Nifty is at 5880. We'll tell you what investment strategy you should be adopting at this point. Bank stocks are back in focus with RBI taking measures to tighten liquidity. We'll tell you which banks you should hold on to. We talk portfolio fundamentals with Hemang Jani. Welcome to All About Stocks. You're watching ET Now. I'm so glad you joined us this week. Now, we've had a difficult week, the Nifty ending at 5880 on Friday. It's a difficult week to understand, and it's a difficult market to predict. Which is why I'm so glad that the guest we have in the studio this week is going to take time out to explain to us, first of all, what's going on, and then tell us what our investment strategy will be. He'll advise us on how we should be navigating this market and cherry-picking just the right stocks that will make us rich in the long term. Now remember, all of the calls you hear on the show today are for a 3 to 4 year horizon at least, not less than that. Before we go any further, let me bring in Avan, who has a report on how the market performed this week, so we can bring you up to date. Avan.
A roller coaster ride, that's what it was for the equity markets, and by the end of the week, it was sub 6,900 on the index. Well, we had big earnings coming in. It was the expiry, the new RBI norms, and there was quite a bit of volatility in the currency space as well. Well, after all the give and take, the frontline indices ended lower by just about 2%. So 2.3% down for the Nifty. The Sensex was down by 2.8%. The Bank Nifty, after being pummeled out of shape, shaved off close to 5% for the entire week. In fact, we surpassed some crucial levels on the downside on that one. Capital goods as a whole also was backed out of shape, close to 10% down for the entire week on account of the disastrous set of numbers that L&T doled out. And even for the broader markets, there was absolutely no respite. You had the mid and the small cap indices which shaved off over 3%. If you had to point out one key pack which was in focus, it would be all of your banking names from the frontliners as well as the mid caps on account of the new RBI norms. You had the big deal which came about in the cement space, so Ambuja and ACC, they were pretty active on account of that. Metalback was beaten pretty badly out of shape. Lots of earnings came in. The good ones were few and far between, the likes of Hero MotoCorp, Sun Pharma or Bajaj Auto. ITC was a disappointment, as was L&T, Punjab National Bank, Yes Bank and a Central Bank. Well, you have an important week slated that's coming up. You'll have the crucial RBI policy as well as some key numbers coming out from the likes of ACESA Goa and ICICI Bank.
All right, Avan, thank you for that update. Now, joining us now is Hemang Jani, who joins us from Sharekhan. Hemang, thank you so much for joining us on the show. Especially on a week like this, this market is becoming more and more confusing for retail investors. I want to first ask you, the thing that we're looking at right now is an RBI policy next week. The RBI has given us, like Avan was just telling us, a series of bad surprises, negative surprises that have affected our markets, have affected our stocks. Are you expecting any more negative surprises from the RBI?
At least in the short run, given the fact that the rupee has already appreciated a little bit, I don't think RBI could surprise more negatively in terms of more curbs on the liquidity or interest rates. But RBI definitely has set its priority in terms of stabilizing the rupee first, and the liquidity in the system has already been sucked out, and we've seen that the 10-year bond yields have actually spiked up from 7.55 to almost about 8.16. So we think that in that kind of a scenario, RBI would want to see the effect of the measures which they have already taken. If the rupee stabilizes for next probably 2 or 3 weeks, then probably we might see some positive surprises from RBI.
Well, Hemang, explain to us right now what is the nature of the market that we're in. And as retail investors, how do we approach it? So first explain to us what's going on in this market. We saw both the Sensex and the Nifty go below those crucial points. The Nifty was at 5880 on Friday. What does that mean? How do you expect it to play out over the next couple of weeks?
See, first of all, what we are seeing right now is that there is a huge divergence in the stock price performance also and the operating performance of various sectors. So the Nifty or the Sensex is not actually reflecting the true picture of the market, because few index heavyweights, be it HUL or Reliance or some of the IT stocks like ITC are holding out the index. But if you look at the broader market, most of the stocks are at probably 5,000 levels or below that. Same is the case with the operating performance. If you see the quarterly numbers, we had good set of numbers coming out from IT Pack, to some extent FMCG and Select Pharma. But large majority of the sectors, though some of the companies are yet to announce their numbers, but the numbers are not good. And what is more important is that if you look at the management commentary, nobody is expecting a revival to happen soon given the kind of steps that the RBI has taken. So in that kind of a scenario, we think that the short-term bias for the market would remain a bit negative, maybe around 5,500 or thereabouts.
Okay, so if I understand this correctly, what you're saying is that some big companies that have had good numbers, like an Infosys, a TCS, an HUL, are holding up the Nifty and the Sensex, but the broader market, the rest of the market is not doing as well. So it might be likely that if, as viewers, we were disappointed with how the Sensex and the Nifty is doing, that our actual stocks are doing far worse than that.
That's the case. In fact, if you see the broader market performance, particularly the mid-cap index and some of the stocks, they have actually gone down far more than the index, which is clearly reflecting that the performance is much worse in that broader market space.
And you said that, management commentary has been pessimistic, the fact that you are a little pessimistic in the short term as far as the market is concerned. What do we do now? Should we just, stay out of it and wait, hold on to our stocks, buy more? What should be our strategy at this point?
Well, clearly, first of all, we should see to it that our portfolio is a little balanced. We should not have too much of exposure to these sectors which are not going through a good patch.
Can you name a couple of those
sectors? For example, PSU banking space is clearly under pressure. We think that it might remain under pressure for next probably couple of quarters. The material space or the commodity space is clearly going through pressure. Even infrastructure, if you see the performance of some of the companies, including L&T, it has not been that great. And given the fact that there is going to be a delay in the investment cycle to pick up, this particular sector is also likely to come under pressure. So we think that there is a case for some kind of a rebalancing which is required in the portfolio. Also, the fact that, at times we see a quick reaction in some of the stocks. Like, for example, stocks like Yes Bank and IndusInd Bank have corrected quite sharply in the last about couple of weeks after the RBI steps. So that might provide a good opportunity for investors because operating performance of some of these banks have been good, and though there might be some margin pressure because of the short-term rates going up, but we think that it provides a great opportunity for investors to buy in a phased manner.
Okay, so you did tell us to avoid a couple of sectors. Now, among the sectors that you say we should be considering, can you give us a checklist that we can use to pick stocks that do make sense in this market?
Well, clearly, we have to focus on the large cap stable stocks and some of the sectors where there is stability in terms of earning, where the rupee is not going to play a spoil sport. Also, the fact that the interest rates are going to take a while to really come down. Companies which have a huge amount of debt on their books also will not do well. So, some of the companies in the IT space, though they have run up quite a bit, but they would provide good stability. So, we should look out for some opportunities in the IT space. Private sector banks clearly is a great opportunity because there was a ownership of the FIs, and because of this RBI steps, we've seen the weakness. Particularly Yes Bank, to some extent, even Axis Bank could provide a good entry point. Auto as a space has also been really under pressure, but something like a Maruti and to some extent Mahindra could provide a good opportunity to accumulate in this weakness.
All right, so that's very interesting. Now, Hemang giving us the sectors to avoid and a checklist of stocks that we can consider in a market like this. We're going to take a couple of questions. Gaurav has written in, 700 shares of Yes Bank bought at 425 rupees. Should he hold on? Yes Bank ended the week at 367. Now, like we were discussing, the RBI's liquidity tightening measures came as a bit of a surprise to the market, caused volatility in the debt markets and, of course, in the banking sector. Now, the RBI has reduced the Liquidity Adjustment Facility. You might have heard about it, LAF, that's what the news has been calling it, of each bank to 0.5%. So what this does is limit the access to borrowed funds that these banks have. I'm going to bring in my colleague Ajay, and he's going to take us through what happened to banking stocks over the last 1 week and that Bank Nifty that really took a beating. Ajay.
Well, that's correct, Faye. Banks was and definitely one area where there was a lot of pressure seen in the market past couple of days. In fact, if you look at the July series, the bank index is down over 6%, whereas the market has actually gained close to 5%. So this was definitely not participating in overall market, which was gradually moving higher. And especially after the RBI norms hit the market, this has started underperforming the market. The RBI has announced squeezing the LAF window and, of course, increasing the CRR requirements for the short term, and it has its own impact on the overnight borrowing rates, which have risen to double digits, almost 10 to 11% now. And brokerages have also reacted by saying that couple of banks, of course the entire sector's earnings come under cloud, but there are specific banks which will be impacted more than others. They go on to say that if the government does not roll back or the RBI does not roll back these measures in the short term, there could also be instance in the second half of the year we could see rates in the system actually heading higher. Of course, in the same time, they also expect the volatility in the yields and the banks to continue in the medium term. We also saw yields surging to almost a one-year high. Of course, Yes Bank, IndusInd Bank, Kotak Mahindra Bank were being seen as the worst hit. However, some of the areas like SBI or HDFC are being seen as the least impacted by these norms according to brokerages. NBFCs are also not spared because of these norms, and M&M Financials in that light is being seen as the worst hit among NBFC space because of the new norms. So this will continue to remain one drag, one area which will be weighing on the sentiment in the market till these norms are actually reversed according to analysts.
Alright, Ajay, thank you for those numbers. Even bad news on the bank nifty. It does look like it's free falling. You were just talking about banks, and also for the benefit of the viewer who's written in, who's holding one bank stock. What's your call on banking stocks right now? Because we all have banking in our portfolios. It's making us all nervous. Should we at this point, like you said, focus on private and stay away from public sector altogether?
Absolutely. I think PSU banking space, the overall performance has been quite patchy. Also, we don't know how long this NPL, the restructured loan part, the slippages part will continue. And obviously, the short-term interest rates going up also would mean that the treasury gains would not really happen in a major way. So, at the moment, looks like PSU banking space is a stay away. But private sector banks, we think that particularly something like Axis Bank, Yes Bank, to some extent IndusInd Bank, this kind of a sharp correction provides a good entry point. Remember that even for next couple of quarters, there could be pressure on the performance of some of these banks because the NIM could actually come down. Plus, the loan growth in this environment is unlikely to be that great. So, the performance may not be that great, but we think that time and again they have demonstrated their ability to manage this kind of a scenario much better compared to PSU banks. So, it definitely from a 1 or 2 year perspective is looking interesting.
So, for Gaurav who's holding Yes Bank, you're saying buy some more?
I think it makes sense because it has corrected quite a bit, and at this price it is looking much more compelling at about 1.8 times price to book. It is looking pretty attractive.
Alright, so you can actually average out your Yes Bank stock. Sandok has written in 50 shares of ICICI Bank bought at 650 rupees and 50 shares of SBI bought at 1640. Should he hold on to both of that stocks? You have mentioned ICICI, so I'm assuming you're going to ask him to hold on. But SBI is the big question here. This is a stock that a lot of our viewers bet on. They added to their portfolio. You added to your portfolio as well. Should we be holding on to SBI?
Absolutely. See, the fact of the matter is that, yes, PSU banking as a space is going through a lot of pressure. But the stock has already corrected quite a bit from maybe 23,000, 2400 odd levels to somewhere around below 1800. Currently, it's quoting at about 1 to 1.1 times price to book. Now, SBI has a huge component of CASA deposits, so their overall cost of funding is going to be less. And we had indications coming out from the management that the overall NPL picture is looking better compared to previous couple of quarters. So we think that most of the negatives have to a great extent been priced in. Probably next 1 or 2 quarters it might remain subdued, but it's a great bank. I don't see a much weakness in that particular space from here on. But one needs to be a little selective about which banks you enter at this point of time as far as PSU banking space is concerned.
Alright, so hold on to both of those stocks. Hemang Jani is with us as well in our studio, helping us with our stock investments. Of course, he's been helping us now for over 2 years. Hemang has designed a portfolio for us. Now, this portfolio is designed for long-term retail investors who have at least 3 or 4 years to invest in their stocks. Now, we started this portfolio on the 4th of January this year. So far, it's given us a loss of 7%. The Nifty, on the other hand, has lost about 2.5% at the same time, in the same period, which means we're underperforming the Nifty marginally. I'm going to give you a list of the stocks that Hemang has recommended for us. Right on top is TCS, that's worked very well for us. Maruti, ICICI Bank and SBI, they've taken a beating. L&T, that's also taken a beating in the last couple of quarters. Reliance Industries, Grasim, Zee Limited, Aurobindo Pharma and Specialty Restaurant. We did talk about banking. ICICI Bank, SBI, both down 20% on this portfolio. Are they still the best bets? You spoke about them earlier on the show. Simply hold on to them?
Yeah, it makes sense to hold on to them because what is happening is that most of the large investors are hiding behind some of the defensive pockets like maybe IT or FMCG or pharma, and their valuations also have reached a certain level from where it doesn't make too much of sense from an investment perspective. So some of these sectors which have not done well, probably next maybe 1 or 2 quarters will remain patchy. But I think from an investment perspective, if you have a balanced portfolio, you should definitely continue to hold on to some of these stocks which have really gone down because they are good quality, stable stocks.
Well, the other thing I'm worried about, specialty restaurants down about 25% since we invested. Obviously, in a market like this, a lot of the discretionary spends will be cut down on, which means expenses like restaurants and things like that, people are possibly cutting back on. How much patience do you want to have with specialty restaurants? How much time do you want to give it?
Clearly, there is a slowdown in that space, as you rightly mentioned, that the discretionary spend is on its way down. And we think that the good part about specialty is that it's a debt-free company. It's on its way to expand, its presence. The same-store growth is going to be muted because of the current scenario that we are in, but it continues to maintain a decent margin of about 20%. So we think that one should give maybe 2 or 3 quarters for it to really see how it is performing, how it's actually dealing with its expansion plans, and more importantly, how it's able to control the cost in this kind of an environment. We have a great respect for the management, and we think that one should give maybe 2 or 3 more quarters.
All right. So in this entire portfolio, no changes right now?
At the moment, I think we should stick to it.
So this is an interesting lesson for all of us. All our portfolios probably look a little soft right now, and that's because it's a tough market. Even they're telling us that if you pick the right stocks, all you need to do is just sit tight and not panic. I'm going to give you a recap of the stocks he picked for us, so you can take them down. There's TCS, Maruti Suzuki, ICICI Bank, SBI, L&T, Reliance Industries, Grasim, Zee Limited, Aurobindo Pharma, and Specialty Restaurant. Time for us to take a few questions. Sujit has written in. He has 156 shares of Ambuja Cements, which he bought at 169, and he wants to know if he should hold on to this stock. Now, we do know that ACC Ambuja Wholesale, that restructuring deal was announced this week. If you're not up to date with the details, Ajay is here with what happened. Ajay.
Well, sir, definitely this was the biggest corporate development of the week and one of the biggest M&A deals we have seen in the cement sector, in which Wholesome is via Ambuja Cement buying out 24% in ACC by paying 3,500 crore rupees from the Ambuja balance sheet. In addition to that, they also aim to buy additional 26% in ACC via a share issue. 58 crore shares of Ambuja will be issued in order to get these additional 26%. So basically, around 15,000 crores being paid to acquire 51% in ACC, and Wholesome India will cease to exist as a company. Now, most of the brokerages have raised a red flag, saying that this is not friendly for minority shareholders of Ambuja. It will not only take away the cash from its books, but is assigning undue premium to ACC. The entire company is being valued at 30,000 crores. Of course, it also goes on to say that minority shareholders' rights are also being ignored via this particular deal, and some question mark regarding corporate governance issues are also being raised by investor groups. We saw market giving a big thumbs down to this particular deal, and saw both the stocks coming under pressure in the trade which happened after the deal was announced next morning. Most of the traders on the street and the analysts believe that this overhang will remain at least for some more days till more clarity emerges regarding the this deal going forward.
All right, Ajay, thank you for that information. Before we go on, talking about this, there was a lot of talk about the fact that Ambuja Cements smaller investors, which is retail investors like us, possibly got elbowed out of this deal. They got a very raw deal. They were not being looked after by the management. Has your research also said that?
Yeah, absolutely. The way Wholesome has gone about doing this deal, wherein they've sucked out about 3,500 crores from the system, they've paid a much higher price for the ACC compared to the current market cap. More importantly, Ambuja would end up being a holding company with some stake in ACC, and typically we have seen that the holding companies are getting much lesser valuations from the market. The discount could be anywhere from 20 to 30% to even higher. So given the nature and the structure of the deal, it looks like that the minority shareholders have not got a fair deal.
Okay, so what's your advice? I'm going to take it piece by piece. Let's talk first about Ambuja. What's your advice to investors who are holding Ambuja, just like a viewer who's written to us today? What should they do?
I think clearly at this price around 175 or so, still it looks quite expensive, and given the negative sentiment around the stock, we think that it makes more sense to actually move out from Ambuja and move into something like an Ultratech Cement, which looks much better in terms of the capacity expansion. Most of the operating parameters it's doing better. So we think that one could shift to Ultratech.
Alright, we have a question on ACC also for you. Murli has written in 49 shares, bought at 11.49. Should he hold on to ACC? That's the second question for viewers who have ACC on their portfolio. What should they do?
We think that for this entire exercise that Holcim has done, ACC shareholders are relatively better off because they're paying a little higher price for ACC stake. Plus, they are looking at adding the stake by another 10% over the next probably 6 to 12 months. So we think that ACC shareholders for now can hold on to it because in terms of valuations, it's looking much attractive at about $120 odd per ton capacity. So it looks okay, one can hold on to it.
Okay, hold on to ACC. Very quick question. Rahul has 10 shares of Ultratech Cement, bought at 19,009 rupees. Should he hold on to it? He did say Ultratech looks better at this point, but given the changes and the consolidation we're seeing in that sector, as a long-term investment, where does Ultratech stand?
It looks very good because this is the only company which will have a much significant capacity expansion over the next 12 months from 52 million tons to almost 62 million tons. In terms of operating profit or EBITDA per ton, it's about 1100, which is the highest in the cement industry. And in terms of valuations, it's quoting at about 130 rupees per ton, which is definitely looking attractive. And there is a good amount of visibility for that particular company. So we think that one can hold on to it.
So if I were to give you three choices, Ambuja, ACC and Ultratech, Ultratech is a clear choice, sir.
Absolutely.
All right. So there you have it. That's the cement industry analyzed for you. Quick break. Hemang Jani is with us in the studio, helping us like he's been doing for the last 2 years with our stock investments. Well, Hemang, it's time for us to pull up your report card from the last time you were here. You recommended United Phosphorus, but it was trading at 120 rupees in August last year, I beg your pardon, with a target of 170 for 1 year. So that 1 year is up now, and I believe the stock is about at 140. That's on your screen. It missed the target. Do you believe this is temporary and it will go on to hit that target eventually? For those of our viewers who bought the stock when you recommended it, what should they do now?
Well, they can hold on to it. Overall operating performance of United Phosphorus has been good. The management has reiterated its guidance wherein the overall growth in the profit is going to be about 15 to 18%. It's having an operating profit margin of about 18-20%. And last 2 or 3 years, the company has been consolidating. They've done some major acquisitions. So one can easily hold on to it with a target of about 170 from current levels.
Okay, and how long do you think it's going to take to achieve that 170 now?
About 6 to 12 months it should take to reach to that target.
Alright, so hold on to United Phosphorus, they're believing that it does make sense to hang on to that stock. It will hit 170 in another year's time. We have time to take in our rapid fire portfolio. Rinkesh is written in. He has these stocks in his portfolio. Hemang, he wants you to help him decide whether to hold on to them or to sell them. 25 shares of HUL, bought at 435 rupees. Now, I remember when we talked about the open offer from Unilever, you did mention the fact that you don't expect HUL to go past 600, but it did. What should he do now?
I think at current levels, it's looking expensive. Operating performance has not been that great, and we think that this might continue for next 2 or 3 quarters because there is going to be some kind of a moderation in the volume growth. So he might get a better entry price for HUL. The stock is good, but probably it could correct about 10 to 15% from current levels given the operating environment that we are in.
So if he's holding the stock which he bought at 435, should he be booking some profit at this point?
I think it makes sense to book out at this point of time.
All right, book out at this point. 25 shares of Tata Global Beverages which he bought at 155 rupees. The stock ended the week at 157. But it's a promising stock. Given their deal with Starbucks right now, would you recommend he holds on to it?
Yeah, he can hold on to it. The company is doing much better, and we think that there's going to be some improvement in the margins because we've seen that globally tea prices have actually come off. So that is good news for Tata Tea. He can hold on to it.
All right, hold on to that stock. Tech Mahindra bought at 1,044. What should he do? That's the last stock.
That looks quite promising after this merger with Mahindra Satyam. It has become third or fourth largest IT company with presence across verticals. IT is the flavor of the season. Rupee would work to their advantage, so he can easily hold on to it.
Alright, so hold on to all of your stocks. It does seem like you have a promising portfolio. That unfortunately brings us to the end of the show this week. Email ID is at the bottom of your screen. If you have any questions about your stocks, for Hemang specifically, write to us on that email ID. Hemang, thank you so much for spending time with us in the show this week. A copy of the show will be available on our Facebook page, and you can also reach me personally on Twitter. Thanks for watching.